Our guest hosts for the entire next hour. David Kotak, Chairman and CIO of Cumberland Advisors, and Luca Silippo, Chief Economist at Natixis. David, I want to get your thoughts. I don't know if you were watching the entire speech out of France where you are right now, but he seemed very presidential. He was there, very warlike, behind the desk, but I don't know if you heard something I didn't. I didn't hear a specific battle plan out of his mouth.
Nicole, good morning. It's nice to see you. He doesn't have a battle plan. He is a beleaguered president. He is losing his base of support politically. He's been in office a year and a half. He announced no energy policy. He opened offshore exploration for oil and then confronts the spill. The first government estimates were 1,000 barrels a day, then 5,000 barrels a day. We're now close to 50,000 barrels a day. This is a president in trouble, and he's acting like a desperate politician, which makes it worse.
Luca, President is obviously trying to do a little bit of political damage control, as David was alluding to, but is it too little too late at day 58 now?
Well, probably, it's a very difficult situation. Probably was.
View on this. I'm delighted to say Jim Rogers has joined us as well. Jim Rogers is out in Madrid, I think, at the moment. Jim, very good to see you. Thank you very much indeed. Look, it's hard to get away from this BP story as well. But what I want to do is look at it from your point of view as an investor. Is there some obvious trade that we can put on at the moment, or is it still too binary, i.e. BP is a real sell or it's an aggressive buy? Is there some short-term trade we can put on to take advantage of what we're seeing on the political spectrum and indeed the Gulf of Mexico spill?
Well, I know of no short-term trade. I'm not very good at that. I guess if anything you would buy oil, because what's going on around the world now is that drilling is being cut back and being regulated even more and more. So no drilling, no oil, higher prices.
But Jim, there is an awful lot of oil around. I mean, dare I say it, if it was left up to the real supply and demand fundamentals, wouldn't oil be trading 20, possibly $30 lower?
Well, Steve, if you think that, I think you should be shorting oil. You're looking for a short-term trade. There
I
it
would
is.
never take on the
Short
speculators,
oil.
Jim. Never take them on.
Well, IEA, the International Energy Agency, is going around the world pleading with governments to understand that the world is running out of known oil reserves. It sounds like you know something the IEA and the oil industry doesn't know.
No, Jim.
Where's the oil, Steve? Tell us. Tell us, Jim, so we can buy it too.
Jim, trouble is, though, it's been 40 years we've been talking about the world having only 40 years worth of oil left, isn't it?
Well, I haven't been talking about that for 40 years. I didn't know you were that old, Steve. But if you are, then you know something we don't know.
Look, I mean, the fact is, of course, we are going to run out of hydrocarbons at some stage, but it's a question of timing, isn't it, as well? And when we look at the statistics for reserves around the world and the number of days of cover, clearly the oil producers themselves feel very uncomfortable about those level of reserves. And, of course, they themselves over at places such as OPEC, they can't keep together on this. They are overproducing, and it does appear across the world there is, at the moment, in the very short term, a lot of oil around, Jim.
Well, there may be at the moment in the short term, but this is, if there is, what's going on in the Gulf and with drilling is going to take care of some of that short-term overage. But Steve, to remind you, the IEA says that the world is running out of known reserves of oil. I mean, this is not some wild oil man or some speculator. This is the IEA. They've studied every oil field in the world. There is no more known. The world is running out of known reserves of oil, unless apparently you know something that they don't know.
Well, look, I tell you what, I see a Klondike round every corner if I listen to the industry, whether it's gas shell, whether it's tar sands, whether it's some form of new gas product of actually turning this into something that's more sustainable. There does appear to be more alternatives coming onto the table, and when we're talking about alternatives, and President Obama is talking about alternatives, clearly at $75 plus, a lot of these appear more attractive. There are more alternatives the higher the price of oil, aren't there?
Well, of course there are. You know, at $200 oil, they'll be drilling for oil at the lawn of Buckingham Palace. They'll be drilling on the White House lawn at $250 oil. Of course there are alternatives. But many of them, solar power, for instance, is not competitive at $75 oil without subsidies. Wind power is not competitive at $75 without subsidies. Sure, but at $200, everything is competitive.
Hey, Jim, David Kotak in Paris. It's nice to see you. I missed you in Singapore. I'm sorry that we couldn't connect. Quick question. If we're going to expand energy in alternate sources, we've got to change tax structure and incentive structure to make the price competitive. Do you agree that's what it takes to do it?
Of course I do, David. And by the way, it's nice to see you. It's strange that we have to meet this way instead of in the U.S. or Singapore or somewhere. Of course we have to change that. I mean, $75 oil is not enough to get people to explore for more, not enough to bring out lots of alternative energy, not enough to cause people to cut back consumption. But as prices go higher, all of those things will happen, and eventually you end the bull market in oil. The solution for high prices, David, as you know better than I do, is high prices. That's how you solve these problems.
But we're not seeing that in U.S. energy policies. We haven't seen any U.S. energy policy to make that shift. In our view, I suspect you agree with me. I'd be interested in your view.
Well, no, of course we haven't, but hey, there's been no president since Jimmy Carter. I mean, this oil problem started actually started even before Jimmy Carter. America has done nothing about it except hope it goes away. That's not a solution to the problem. Obama at least said, well, now we're going to drill more because we think there's a lot of oil offshore. Now he stopped that. So, I mean, no, we don't have a policy to solve the problem in the U.S.
All right, Jim, we want you to continue staying with us. Jim Rogers, Rogers Holdings, talking to us live from Madrid, and David Kotak, our guest host for the hour, still continues to stay with us. On to our next story. PIMCO, one of the world's biggest bond managers, beginning to invest in equities. The move marks a significant new route for the company's investment strategy. It also underlines a divergence in the returns available between bonds and stocks. Early this week, PIMCO launched 2 actively managed equity funds, one of which was centered on European equities. Bill Gross, the founder and co-chief investment officer, told CNBC the reason behind PIMCO's new strategy.
We're, recognizing that the global marketplace is not just bond-oriented, and so equities have a place, always have had a place. And we think that PIMCO's secular view and our tops-down type of process, as well as our analysts, can make a difference in that market.
Well, to talk more about it, let's bring in our guest speakers again. David Kotak, Chairman and CEO of Cumberland Investors, Lucas Sillipo, Chief Economist, Natixis, and of course Jim Rogers, CEO of Rogers Holdings, continue to stay with Luca. Let me start with you first. What do you make of Bill Gross saying, he's going to put his money into equities, but European equities? Do you think it's a good idea?
Well, as I said, valuation are very, very attractive. European stock markets have been down significantly. And if there is no major, banking crisis in Europe, probably on a secular view, as Bill is calling it, they are right in entering the stock market right now. One or two risks. The first risk is that eventually something is going to happen to European banks, which is not our view, but it could happen, some other liquidity squeeze or credit crunch or whatever. And the second risk is that I see more and more investors in my job waiting to enter the bond market still in Europe. So they wait for a drop in prices, a temporary drop in prices to enter that market. So the appetite for bond is not over yet. But on a long-term perspective, probably Bill, of course, is
we also had some comments from George Soros saying the European situation is actually going to see a recession in the region. Does that not worry you?
No, I don't think so. I think that this is a really risk scenario that is linked to the evolution in the banking sector. So if there are more problems in the banking sector in Europe, then you are going to see a recession. Our central scenario is to see very weak growth, as it has been in the last three years now. So very weak growth, but no recession. Okay.
Jim, what about you? Are you going to be buying into European equities?
Christine, again, it's strange we have to meet this way. Here I am in Madrid and you're in Singapore. I'm not buying European equities right now. I did buy the euro on Friday and Monday, as you know. That, if nothing else, and if that works, then there'll be a play in the currency if you invest in Europe now. I'd rather be investing in Europe right now than in the U.S., for instance. If they're not here, there are going to be plenty of opportunities, and it's as good a time as any to start.
What are you investing in Europe? What are you buying?
Well, I bought the euro. I bought this is Jim Rogers. I bought the euro on Friday and on Monday. I don't know whether it's just for a trading bounce or whether it's going to be fundamentally sound for a long time now. I do know that European governments say they're going to do the right thing now. If they do, it could be the beginning of a nice long move in the euro. I don't believe them, of course, but maybe they mean it this time.
Yeah. Christine, we made a different move in our shop, although I think Jim and I both see the euro and the eurozone and U.S. very similarly. At least it seems to be the case. But we have actually taken Northern Europe weights up in terms of equities, and we only use exchange-traded funds. We have taken Germany to an overweight. The largest stock in the German index is Siemens. Daimler is a large weight. The price of a Mercedes in Beijing is now 20% cheaper than it was because of the currency shifts. So we think that there's actually going to be a more robust resurgence in Northern Europe. I wouldn't touch Greece. I wouldn't touch the Club Med countries yet, although the jury is out as to whether they can make changes. But equities in Europe are cheaper than they have been in a very long time.
And Luca, jump in. You have something to say.
Yes, no, I wanted to ask a question to Jim. You said the governments maybe this time will do it right. Don't you think it's more about what is going to be done at the European level? So this increase in the federal budget, for example, that would solve a lot of problems of asymmetries in Europe.
Well, you've got to do it at all levels. You have to do it at the country level and at the federation level, if you want to call it that. No, it's got to be a combination of everything. Now, the EU says they're going to force everybody now to run a tight ship. Now, they said that in 1992 when they wrote the treaty. They've said it every year since, and they've ignored the treaty, as you well know. But they say it now. But it's got to be everybody. If it's not everybody, it's not going to work. Look, Greece is 2% of the economy. They cause chaos in the whole thing. So it's got to be everybody, even the small ones as well as the large ones.
Jim, it's fantastic speaking to you, albeit on a satellite from Madrid, but always a pleasure locking horns with you. Jim Rogers of Rogers Holdings, thank you very much indeed for joining us. And indeed, I think the other gentlemen, Luca and David, are both staying with us.